Hello and welcome to our multi-part series on the home buying experience brought to you by the Mattox Group. We're going to break this seminar up into a number of sections to highlight the key things that you need to know about the opportunities, the challenges, the overall experience, and some of the pitfalls to be aware of if you're buying your first home or looking to buy a new home. As a breakdown of a seminar we provide with our trusted housing team throughout the Central Coast here of California. I am Jay Fagan, the founder and CEO of the Mattox Group and your host for this presentation. Born and raised in the Show Me State of Missouri, I have been in business here on the Central Coast of California for nearly 20 years. My lovely wife and our two children are proud to call California home, in particular the beautiful Monterey Bay. We're privileged to live here, and we enjoy serving clients throughout the state of California and across the country. Session 2 of our home buying seminar. In this presentation, we're going to talk about how much home is the right home for you. Budget, finance, inclusive figures to consider in your home buying budget, what your average payment actually entails, and more details as to how it might impact your taxes and other parts of your financial life. So let's get stuck in. How much home is too much? If paying for your home is stressing you out, you bought too much home. Remember, this is your first home, which statistically means it won't be your forever home. Buying a home where the monthly payments are less than 1/3 of your monthly take-home pay is a reasonable investment. Less than a quarter? That's gravy on the biscuit. Remember, too, your income isn't static. If you need to stretch a little bit in the first year, having a reasonable knowledge that the next year and beyond is moving into peak earning potential, that risk-reward calculation may pay off. Discuss your specific scenarios with your trusted advisors and make smart financial decisions built on good data. So you've decided to buy a home. What's it going to cost you? Firstly, we want to consider your net take-home pay. This is the money that you have each month after all taxes, deductions such as health insurance or 401k contributions, and any other withholdings are taken from your paycheck. For self-employed persons, this would be your net monthly pay after taxes, expenses, and other benefits. Your net take-home pay is what drives your smart home purchase. For those of us who grow up with the A-team, you've always heard the phrase, "I pity the fool." Well, here we mean principal, interest, property taxes, and insurance, or PITI. This is the total payment necessary each month to purchase your home. Should you require private mortgage insurance, that would be added to this payment, which would turn PITI into Pity P, also known as PITI's financially challenged drunk uncle, who's always trying to shake you down for a handout. PMI is the worst. And unfortunately for a variety of homeowners across the spectrum, certainly in California, PMI is going to be in your future because putting 20% down on a home in California isn't easy. We do encourage it. Good financial sense dictates we have to encourage it. No PMI, greater loan to equity. You're going to be more recession resistant. You're going to be more resistant to challenges that might, pop up just in life. But PMI is real. It exists. It's somewhere in the ballpark of 0.62 to 1.2% of your payment. And up until recently, it has not been a tax deduction. That is changing effective January 1st, 2026. PMI on the first $750,000 of qualified primary mortgage interest will now be a deduction for those who itemize. So you've found your home, you have sufficient down payment to get old Uncle PMI out of your wallet, and you can afford the payments. You're ready to buy it, and then calamity. Nobody expects the pest inspection. Closing on a home can have unexpected and unavoidable expenses. In our own experience with our first home, as a veteran, I got a VA loan, and we got shaken down for the pest inspection. Things that are called Section 1. You see those in FHA VA loans. The pest inspection pulls up items which must be fulfilled or corrected before you can close on the loan. In our case, it was $1,200 of new decking for a clearly old termite issue. The house had been recently tinted. There was no active termite issue, but the pest inspector documented it. The VA required it, and $1,200 out of our wallet when we least expected it to close on the deal. Make sure you walk through your home inspection, your pest inspection, understand the terms of your loan, understand what can happen, set aside an emergency cushion for unexpected closing costs, moving expenses, and the inevitable surprises that happen once you get into the home. That's going to set you up for long-term home buying success. Now, what do I mean when you hear me say we don't want you to spend $1 to save a quarter? We talk about tax deductions. If you followed any of our videos or you're familiar with some of the financial guidance out there, a tax deduction is spending a whole dollar, generally to someone else, in order to pay the government a few cents less, on average 25 cents across the country. What do we mean by that? So unless you're funding pre-tax retirement, in this case, paying whole dollars to future you, almost everything else you can get a tax deduction for: self-employed health insurance, mortgage interest, property taxes, state taxes, PMI, these points on a mortgage. These are all whole dollars to banks and tax collectors and other people, insurance companies, that result in a reduction in your taxable income, not a dollar for dollar credit. So what does that look like in real life? If you're married for 2025, you can earn up to $571,000 a year, and your effective taxable income will be less than 30%. If you're single, that number drops to $285,000. Now, what do I mean, Jay, effective taxable income? Well, you see, these are the tax brackets. And the way this system works in America, where we have this progressive income tax system, is the amount of money that you earn that falls in each of those respective brackets is taxed at that percent. And so oftentimes when you do your tax return, you might see that on the return, you're in the 24% tax bracket. Well, maybe you're single and your income was $110,000, which fell between $103,350 and $197,300, and therefore that was taxed at 24%. That little tranche of money, that's 7,000 and so was taxed at 24%. That was the highest marginal tax bracket your income fell into. And that number often gets bandied around. But that's not your actual tax rate. That's just the highest bracket some of your income fell into. Your actual tax bracket is adding up all of the tax liability you actually owed from the 10% bracket, the 12% bracket, the 22% bracket, and so on. Or in California, the 1, 2, 4, 6, and so on. Adding up all of the money that fell into those individual brackets, totaling that tax liability, and dividing it by your total income. And that gives you your effective tax rate, not the highest bracket, but your overall effective rate. And if you're making under $571,000 and you live in California, it's going to be less than 30%. So what does that mean with a tax deduction? That means if you paid $1 in mortgage interest, you'd only save 30 cents on income taxes. You're still out 70. So the point being, the best investment you can make to save on taxes is deferring that income today into retirement accounts that you'll draw down later when you'll likely have a lower effective tax rate. Now, you will hear a lot of people talk about the Roth, and I love the Roth. The Roth is after-tax money, so you get no deduction today, but it grows tax-free, and when you retire, you can take it out tax-free. I think the Roth in the right order of operations makes perfect sense, and I love that it exists, and I love that people can take advantage of it. But I work with retirees across the spectrum. My average retiree in California has a liquid net worth of $3 million. We have a number of retirees that are pushing the 10 million or above. And when they retire, in nearly 20 years of business and talking to a lot of colleagues and looking at the statistics, their effective income tax rate, almost to a 1, has never been higher in retirement than it was when they were working. And it's because their income comes from a variety of sources, some that's taxed in these ordinary rates, some like capital gains is taxed separately, some of it's from tax-free sources or deferred sources, some of it's Social Security, at which not all of that is taxable at the federal level. At the most, 85% of it is subject to income tax at the federal level, and none of it is taxed by the state of California. So their effective rate in retirement, generally, my retirees, is somewhere between 8 and 12%. But when they were working, it was between 15 and 25%. So in my line of thinking, Maximize those pre-tax retirement options first. And when you have excess cash flow, you put that into a Roth, because all of my retirees generally have a Roth. They don't live off of it. They use it for vacations, buying new homes, taking, spending some money on the kids, things that they want some tax-free income for. They don't want to pay taxes on it, but it's not a requirement for their overall living situation. So buying a truck, paying interest to a bank, writing off your home office, cell phone, or whatever scheme TikTok is pitching is paying whole dollars to somebody else just so you'll pay a quarter less to Uncle Sam. Be smart. Pay Uncle Sam his due. We like to live in a society with roads and bridges and safe and secure environment. We all love the privileges that exist being in America. Some of those have some costs. So pay the taxes that are due, not a penny more, and invest the rest in you and a healthy habit of homemade biscuits. So when we look at this real impact in practice of home ownership and taxes, what does an ideal home ownership scenario look like? And this isn't going to be doable for everyone, but let's look at what it looks like in California. A smart purchase, 20% down payment, no PMI, right? So we don't have that extra 0.62 to 1.2, 1.3% fee every month for the first at least 2 years. Your PITI, principal, interest, taxes, and interest, is less than a third of your net pay. Now, you'll hear a lot of folks out there, in particular Dave Ramsey, talk about it being less than a quarter. I don't disagree. I think that's great advice. It's not doable for everyone. It certainly sets you up for great success. And if you can do it, if you can be intentional and set aside that money, get that down payment up there, get that emergency fund, that's fantastic. I reward that with great encouragement. I think it is very aspirational. It's something that people do every day in America and should do. If you don't, less than a third tends to be on the margin of safety. Higher than that, 40, 50, 60% of your net take-home pay, homeownership isn't for you. It's just not a risk that you can mitigate. Property taxes in California are generally 1% of the purchase price. And ideally, you're contributing 15% of your total income to retirement. Owning a home has some great tax-free advantages in future, but in order to take advantage of them, you have to sell the home, which could render you homeless. So contributing to your retirement every step along the way is the right thing to do. A deduction versus a credit, as we said, $1 paid to mortgage interest, and that's about 25 cents average in tax savings for those who itemize. However, I want to note that because of since 2017, the Tax Cuts and Jobs Act, and now OB3, the One Big Beautiful Bill, or HR1, making permanent 2017 standard deductions and adjustments, the standard deduction for married filing joint is over $30,000 now in 2025. So if you paid $50,000 in home mortgage interest and another $11,000 in property taxes, so let's say $61,000, the first $31,500 is covered by the government as a standard deduction. So you're only getting a tax advantage on the amount that exceeded that $31,500. So you've paid out, $61,000, but you're only getting a tax benefit on $30,000. And even then it's only 25 cents on the dollar on average, right? So home ownership isn't a tax savings strategy. Spending a whole dollar just to save a quarter, if you're looking to make that kind of deal, you ought to be a farmer. Home ownership is a life savings strategy. Security, stability, peace of mind. Owning your own dirt is a feeling like no other. It's almost as good as homemade biscuits fresh out of the oven on Sunday morning. Just like investing in your retirement, it doesn't matter if you buy when the market's up or down, so long as you're buying. When you can afford to make a smart purchase, do it. Be intentional about paying off your mortgage as quick as you can. Don't over-improve your home for the neighborhood, and don't raid your equity like a piggy bank for short-term satisfactions. That's what got us into the mess in 2007 and 2008. Buy, hold, and reap the rewards long-term. We've talked about the budget, what it looks like to be safe and secure in a good PITI, principal, interest, taxes, and insurance, all of the other costs to consider when you're looking to move in, looking to get settled, what smart homeownership really looks like. Stay tuned for our next episode in this series where we talk about buying the home and the benefits and really great opportunities that come from homeownership.